All right, guys. This is I think my fourth stream. We're gonna actually go over value stocks. I think that's one of the key pieces when you're, at the beginning of your investment strategy. It should be high growth, building your snowball, as Warren Buffett explained, and that snowball roll downhill until you've accumulated enough wealth where you want to start living off of that. And so the next step of the phase is from wealth creation is wealth preservation. And so that's when you want to start branching out. A lot of people will live off growth stocks. Me, I'm a little bit more conservative. I like to have a mix of asset allocation. And so the current assets that I'm currently in is fine art. I have value. I have REITs, which are real estate investment trusts. I have value stocks. I also have growth stocks, which I shave some earnings off here and there or reinvest. And then crypto. And so I'm hedging my bets across platforms along with owning real estate, physically tangible real estate. It makes me feel more secure. And also, if one is down, the others can help prop up the rest. And so one of the best types of stocks for just income generation, you typically won't get a lot of growth out of them, but good income to live off of is called mortgage REITs or MREITs. And right now they're at historical lows since we've had this crash. This company, Two Harbors, I picked up a ton of shares to live off of, and also they're a comeback play. They're at $6.50 when I bought them. They're at $7.31 right now. They had a high of roughly $18.50, $19. So I'm buying them way under their height, their book value. The mortgage industry should have a great year with the refinances and the real estate is booming, and commercial and actual consumer real estate. Roughly, analysts are ranking them around a 9. They're about $7.53 when it comes to book value. And they currently do like Fannie Mae and Freddie Mac. They buy a bunch of those loans. And then additionally, they do like capital loans to commercial real estate and also asset-based loans and some other stuff like that, along with derivatives. But when it comes down to it, they're a high-end loan company for hedge funds and stuff like that. And also banks, they kind of sell their assets to them. So I'd recommend checking them out. And they were also transitioning from external management to internal management that have a ton of years of experience, and they're looking to basically take it to the next level. So really excited about them. Check them out. I'm up about 20%. Let's go to the next one, which is going to be Lumn, which used to be called CenturyLink, and they're my comeback play. Let's take a look at that chart real quick. And so what you can see about them, I picked them up around $9.86. I'm up roughly about 35, 40%. They were roughly up $16, $17 pre-pandemic. And they've been kind of on a decline. But what they're doing this year is making a pivot. They retransform their name and also their message of where they want to go. They want to be known as a technology company that is known for fiber optics, known for edge-to-edge computing, similar to Fastly, known for security, similar to Okta or to CrowdStrike. And then they want to partner with a lot of the name brand applications such as Salesforce and Zoom and create an all-stop solution where you can get your internet, you can get your applications, you can get your security, you can get your edge-to-edge computing. So, that is promising that they're making a pivot. They want to change and they want to be known. In addition, they're transforming a lot of their copper fiber lines to gigabit optical internet. So the future's bright for them, along with 5G. They'll be doing a lot of the backhaul for Verizon, AT&T, and T-Mobile Sprint. So take a look at them. They're definitely a good company, and it could be a growth company. The next one's called Ladr. So let me pull their chart up. They're a really good company, internally managed. They started in 2008 by an individual that basically is been in the commercial mortgage REITs industry. So what these people do, they're a hybrid. They own physical, tangible industries such as warehouses, commercial buildings, but they also do mortgage REITs too. So it's a combo of the first one, where the first one just does mortgage REITs. So they're a little bit more diversified. I picked this one up first before Two Harbors. They're internally managed. They been through the 2008 crash. Their book value is over $12, so you can buy them under book. Their dividend is around 7, and so is Lumn, and about 8 to 9% for Two. They all have reduced dividends, so they will increase over time. Expect Lumn could possibly double. Two Harbors will most likely double, and Ladr will most likely 30 to 40% increase in dividends from where it's at now. This sector looks bright. Commercial real estate was pretty much unfazed by the pandemic. Industrial specifically, such as cold storage, which they own, warehouses, which they own, were actually improved by the pandemic since everything shifted online. That's pretty much all I got. These three are great to add. Some other ones I'd recommend right now are Boeing. You have Walgreens that I'm looking to add, and IIPR if you want to get some marijuana exposure with REITs. Great growth stock with IPR. Walgreens is definitely a comeback play, and Boeing is pretty much a comeback play too. That's all I got, guys. Share, like, subscribe, and have a great day.